The central banks of the world have purchased 1,250 metric tons of gold, which is worth about $80 billion. And when we talk about a government that by its own estimate will take another 22 trillion in debt over the coming decade just to keep the lights on, so to speak, to roll over the obligations that we have and to continue to fund our spending habits, well, that's an awful lot of money, and I'm sure that those are severe concerns. But think about this. In other words, if the central banks were to purchase, let's say, 5% gold right now in U.S. dollars, just converting 5% would be another 300 to 400 billion in purchases. Now, an $80 billion infusion pushed gold up to its all-time high. At the same time, we have a strong dollar, we have positive real yields, and outflows out of the ETFs. What happens if they just convert 5% of their dollar holdings? And it seems that this has been a trend that's been accelerating. Now, granted, that's $300 to $400 billion. That's 5 times what they bought over the last couple of years. But what I'm getting at is that as these central banks continue to de-dollarize, they realize that inflation has been chosen over austerity.
Good day, investors and financial enthusiasts. Today, we delve into an eye-opening discussion led by Andy Schectman, an expert on precious metals who brings a critical forecast for the silver market in 2024. In his analysis, this is the next massive catalyst for silver, 100x bigger than gold. Andy highlights the monumental shifts in the precious metals market and global economy. Central banks worldwide have purchased 150 metric tons of gold, worth around $80 billion, driving gold to its all-time high of $2,660 per ounce. But why this sudden gold accumulation? The answer lies in the U.S. financial system's weakness. The U.S. government is projected to take on $22 trillion in debt over the next decade, pushing central banks to diversify away from U.S. dollars and into hard assets like gold. Central banks and gold demand. Andy explains that central banks hold around $8 trillion in U.S. dollar reserves. If just 5% of these reserves were converted into gold, it would mean an additional $300 to $400 billion entering the market. The recent $80 billion purchase has already significantly boosted gold prices. An influx of $300 to $400 billion would likely propel gold past $10,000 per ounce. This, according to Andy, is a conservative estimate. Historically, gold serves as a hedge against currency devaluation and inflation, and central banks, being the most informed market players, are taking advantage of this before the broader market catches on.
In gold that could easily be up above $10,000 because 80 billion pushed it up here to 2,600 and change with virtually no U.S. participation. And I think that you are seeing and will see kind of like a hockey stick, right? Where the acceleration in de-dollarization accentuates. And I really do believe that that's as crazy as it sounds to me, a conservative estimate. I can't imagine that all you would see is 5% of the 8 trillion in U.S. dollar holdings that these central banks hold around the globe would be converted to gold. I think that number will be much more. But 5% would be 300 to 400 billion injection into gold. And that's 5 to 6 times what they've already bought in the last 2.5 years, which has been the driving force behind the rise in gold. I don't know. I happen to it's rocket fuel waiting to happen. I really, truly do. And this is a trend that has done nothing but accelerate. Every time we see a Fed cut, gold has rallied as much as 10% in the 6 months after the first Fed cut. So we just saw the first Fed cut. We're seeing increased central bank demand. And we're now beginning to see the ETF start to tick up. I mean, in terms of you try to lay out an argument for a bullish case for gold, I don't know their path, and that is one of inflation. And so when you talk about inflation, sanctioning, all of the things that these central banks are thinking of, not to mention the BRICS and their gold-backed settlement currency, which again has been reconfirmed that this indeed is real and will be discussed in the meeting here in the next 3 weeks. We could see much higher prices over the next 6 to 12 months, especially as we are now banking another 50 basis point rate cut. At least that's what the smart money thinks will happen. So yeah, in every metric, gold is at all-time highs. But maybe the flawed logic is that it should be a whole hell of a lot higher. That it's been suppressed for so long that these numbers that we are all awestruck over are really well short of the mark, just because it hasn't been able to reach its real price due to the massive shorting on both the LBMA and on COMEX. Maybe, just maybe, all of these other assets that have reached such stratospheric highs, and gold and silver kind of painting a picture, allowing most people, including maybe even you and I.
This could trigger a sharp upward curve, as seen when the Fed cut rates and gold rallied by 10% in 6 months. Implications for silver. With central banks aggressively buying gold, silver is likely to benefit as well. Silver has a higher beta compared to gold, meaning its price movements are more volatile and potentially more profitable. If gold reaches $3,000 per ounce, silver could surpass its historical highs of $50 and even move towards $100 or more. Silver also has an advantage in industrial demand, particularly in the renewable energy sector. China, the world's largest solar panel producer, has been stockpiling silver, paying premiums for raw supplies due to its strategic importance. This dual demand, monetary and industrial, positions silver for significant growth as the global energy landscape shifts. Manipulation and market dynamics. Andy also discusses the manipulation of gold prices. Major financial institutions have been accused of artificially suppressing gold prices through short positions on the LBMA and COMEX. However, with central banks and public investors increasing their holdings, it's becoming harder for these entities to control the market. As demand grows amidst inflation and economic uncertainty, the fundamentals could overpower any manipulation attempts, leading to a price surge. Even as mainstream analysts predict modest targets of $2,900 to $3,000 per ounce, Andy and major banks like Goldman Sachs and UBS foresee much higher prices, signaling that institutions recognize the ongoing shift.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
UBS says gold has risen by 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of $2,600, ahead of schedule. And according to the World Gold Council, as I mentioned to you, it has historically rallied as much as 10% in the first 6 months after a Fed cut. We now expect gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. Pretty significant, but not as significant as Goldman Sachs, who is talking about right now in the fourth quarter of 2025, by the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, yeah, you know, we're moving to $3,000 an ounce. And Goldman Sachs has said that they're being inundated with precious metals requests on their trading desks, which is a very, very, very big deal, obviously. And it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done. Again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the US and gold started to go up really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie, and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down, and now the ETFs ticking up. This is all huge, and to see Goldman and UBS say these things is again very, very significant. They're acquiescing to the reality that, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going, and that is the key. That maybe these banks realize it's as dumb as a mud wall, like Bank of America, to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery and the LBMA was delivered. 8.1%, over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week, with 160 metric tons purchased by Saudi Arabia, but not disclosing it the way they're supposed to the IMF, because they don't want to upset the big kahuna, the United States. And yet they're playing both sides of this game. Ultimately, if you just put all of these things together and realize that the commercial banks and the central banks, who are the most collectively well-informed and well-financed traders in the world, are telling you where this is going. And if you don't pay attention to the Goldman Sachs report or the UBS report, where the hell do you find it, right? Where are you going to find it on the mainstream? Are you listening to the mainstream, who isn't saying a word about any of this? It's not easy to find and read through these analyst reports for UBS and Goldman Sachs. It sucks reading it, to be honest with you. And they're 25 pages of a bunch of mumbo jumbo. And then they say, yeah, gold's going to 3,000 by the end of the year. But if you only relied upon, and that you consider yourself very well read by reading the Wall Street Journal, watching Fox News, and paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes.
ETF inflows for gold are rising again after years of outflows, signaling growing retail and institutional interest. This resurgence, combined with central bank purchases, sets the stage for significant price movements. When these forces align, precious metals markets typically experience strong uptrends, creating substantial opportunities for gains. Goldman Sachs has reported a surge in demand for precious metals on their trading desks, indicating that institutional investors are already positioning themselves. As the public follows, the market could see explosive growth, especially with inflation rising and the Fed continuing to cut rates. In conclusion, the global financial landscape is undergoing a major shift. Central banks are accumulating gold at unprecedented rates, the public is returning via ETFs, and the Fed is cutting rates, all while inflation remains a pressing issue. The BRICS nations are also exploring a gold-backed settlement currency, challenging the dominance of the US dollar. These factors point towards much higher prices for both gold and silver. If you're considering investing in precious metals, now is the time to act. Whether you choose physical metals, mining stocks, or ETFs, the opportunity is here. Don't wait for mainstream media. By then, the best chances for gains may have passed. Call to action. Gold and silver are not just investments, they are insurance policies against the instability of the financial system. The window of opportunity is open, and positioning yourself now could safeguard your financial future. If central banks continue their aggressive purchases and the Fed maintains its rate cuts, precious metals could see substantial increases in value.